What is stock market? The stock market as we know it today started out very differently, but with the same principles of supply and demand that are present today. People traded goods and services such as farm labor, food, and even flowers. As you can see here, this is a picture of a share from Disney World. The more current stock market in the United States started in 1791 with a group of businessmen trading wheat, tobacco, cotton, and sugar. It was not until the Industrial Revolution in the 1900s that regular citizens participated in the buying and selling of stock. This allowed businesses to raise money for expansion and the development of all the great machinery that was being invented. The three major stock markets in the United States are the New York Stock Exchange, NYSE, the American Stock Exchange, AMEX, and the NASDAQ. The primary importance of the stock market is to allow businesses to raise capital and to distribute the risk. The stock market provides these businesses with the means to do this. Most companies start out as private companies, meaning only an individual or a small group of selected people own them. When they go public, they issue a limited number of stock shares available for purchase for a set dollar amount like individuals like you and me. If more people want this particular stock that is available, the price goes up. In reverse, the price would go down if there are more sellers than buyers. This is the theory of supply and demand. Investors take a chance trying to predict the rise and fall or success and failure of a particular stock or company. With a rising stock market, our economy flourishes because there are a lot of jobs created and billions of dollars passing through the hands of many different companies and individuals.
We have seen that the ownership of corporations was determined by the ownership of the stock. There are two major kinds of stocks issued by corporations: private and public. Public stocks are traded freely in an open market called a stock exchange. The most famous of these is the New York Stock Exchange. With public stocks, anybody, if they have the money to invest, can become one of the owners of companies like IBM, United Airlines, or Intel. The stock market is perhaps the epitome of the free market, where transactions take place exclusively for the purpose of making money.
Shock, disgust, and fear. The international trading indexes are leaving stockbrokers speechless. Everything seems to point in one direction: down. When an index percent value drops double digits, often without warning, market analysts report a so-called crash. It's a time when investors' losses can total tens of billions. One example is the recent crash that took place in January 2008, when many Americans could no longer make mortgage payments on their homes. This resulted in astronomical losses for creditors, especially banks. As soon as the word of the situation got out, bank stocks plummeted, which then set off a chain reaction in other sectors of the economy. Most of the time, the crash catches investors off guard, with no apparent triggers in sight. The stock market often performs well for a number of years, giving investors a window of opportunity to grow their wealth manifold. However, as soon as the rumours start to circulate about a potential blow to the economy, the upward trend reported by indexes comes to a screeching halt. All that's required to nudge the trend downward is a group of investors who want to unload large quantities of shares while prices are still high. Within hours, the problem becomes global. Frequently, the impact of the crash can be felt throughout the entire economy. Money is scarce and consumers cut back on spending, thus slowing business activity. It can take the stock market years to fully recover. So how can investors protect themselves from such a scenario? The fact of the matter is, they can't. People who invest in stocks must be alert or wait till the worst is over. For if there's one thing that past crashes have shown us, it's that stocks will eventually begin to rise again. most of the time trading at new record highs somewhere down the line.
The excitement of the trading floor. Here fortunes are made and lost every day. Let's see what's really going on behind all this shouting. This is the Chicago Stock Exchange, where traders buy and sell stocks or shares of ownership in a company. People invest in a company expecting to make a profit, and companies use investors' money to expand. In a way, collectible baseball cards are like investment stocks. Trading them may be fun, but they can also be valuable and increase in value over time. The popularity and success of an individual baseball player can drive up the price of his card. Some of Babe Ruth's trading cards that originally sold for a penny are now worth between $6,000 and $15,000 because they are in such high demand. The monetary values of baseball cards and stocks are based on supply and demand. An investor who buys a stock owns a small share of the company. More shares add up to a larger part of the company. When a company does well, more people want to own a piece of it. When a company does poorly, people sell their shares in it. This increases the supply of available stock at a time when fewer people want it. That lowers the stock's price. The stock exchange is a giant marketplace where traders buy and sell stocks. The world's largest stock exchange is the New York Stock Exchange. More than 2,600 companies are currently trading stocks there. Though it may look impressive now, the New York Stock Exchange came from humble beginnings. It began in 1792 at a meeting under a buttonwood tree in what is now Wall Street. There, 24 stockbrokers and merchants signed the Buttonwood Agreement, which set the terms for their new investment community. In 1817, it was organized into the New York Stock and Exchange Board. The first European stock exchange formed in 1840 in Antwerp, Belgium. Now, major stock exchanges exist all over the world, where investors trade hundreds of billions of dollars worth of shares every year. Here's how it works. An investor purchases stocks through a broker. A broker acts as a mediator between the buyer and seller. The broker receives an order from an investor and then relays it to a specialist on the floor of the exchange, who completes the transaction. All of this can occur in less than a minute. The process moves at lightning speed. But new developments in trading fueled by the power of the internet may eventually overshadow the traditional system. Communications networks that allow for electronic trading or e-trading have moved the stock exchange from the trading floor to the computer screen. E-trading allows customers to make large block trades as well as very small purchases online. Conversion to an all-electronic system would diminish the need for floor traders. The stock exchange symbolizes commerce and allows people all over the world to invest in businesses. It's where money meets ideas. Investments in companies drive the research and development of new products and new technologies that can change the world.